September 15th, 2008, 1:45 a.m. Lehman Brothers headquarters, Times Square, Manhattan. Dick Fuld, CEO of Lehman Brothers, stood in his 31st floor office looking down at the city that never sleeps. Outside, camera crews were setting up. Reporters were arriving. The world was waiting. In a few hours, Lehman Brothers, a 158-year-old institution that had survived the Civil War, 2 world wars, and the Great Depression, would file for bankruptcy. The bankruptcy would be the largest in American history. $639 billion in assets, $619 billion in debt. 25,000 employees would lose their jobs. The global financial system would freeze. Stock markets would collapse. Banks around the world would teeter on the edge. And the Great Recession, the worst economic crisis since the 1930s, would begin. But here's what you need to understand. Lehman Brothers didn't fail because of bad luck. It failed because of a system designed to hide risk, reward recklessness, and transfer consequences from the people who made the decisions to everyone else. And that system didn't break when Lehman fell. It got bigger. What actually happened at Lehman Brothers? How did a company that had survived for over a century collapse in less than a year? Who saw it coming? Who could have stopped it? And why did the government let it fail when they had rescued other banks? Let me take you inside the rise, the hubris, the warnings ignored, the final desperate weekend, and the moment when everything broke. Because understanding Lehman Brothers is not just about understanding 2008. It's about understanding how the financial system works today and why the next crisis could be even worse. Before Lehman Brothers became synonymous with collapse, it was one of the most respected names on Wall Street. The company was founded in 1850 by 3 German immigrant brothers, Henry, Emanuel, and Mayer Lehman in Montgomery, Alabama. They started as cotton merchants, buying cotton from southern plantations and selling it to textile mills. After the Civil War, the brothers moved to New York and transformed the company into an investment bank. For the next 150 years, Lehman Brothers financed some of America's most iconic companies. They underwrote the initial public offerings of Woolworths, Macy's, and eventually tech companies in the 1990s boom. By 2000, Lehman Brothers was the 4th largest investment bank in America behind Goldman Sachs, Morgan Stanley, and Merrill Lynch. The company employed 25,000 people in 40 countries. It managed trillions in assets, and it was about to make a decision that would destroy everything. In the late 1990s, Lehman Brothers made most of its money from traditional investment banking, underwriting stock offerings, advising on mergers and acquisitions, managing wealthy clients' portfolios. It was profitable, but boring. Returns were steady, but unspectacular. Then the dot-com bubble burst in 2000. The stock market collapsed. Investment banking revenues plummeted. Lehman Brothers needed a new strategy, and they found it in real estate. In 2000, Lehman Brothers started aggressively expanding into mortgage lending and mortgage-backed securities. They weren't just financing mortgages, they were buying mortgage companies, packaging mortgages into securities, and trading them for massive profits. By 2004, Lehman Brothers was one of the largest players in the mortgage market, and the profits were staggering. In 2005, Lehman reported net income of $3.3 billion. In 2006, $4 billion as Dick Fuld, the CEO, became one of the highest paid executives on Wall Street, earning over $40 million annually. But those profits weren't coming from traditional safe mortgages. They were coming from something far more dangerous, subprime mortgages. To understand what destroyed Lehman Brothers, you need to understand the housing bubble and subprime mortgages. In 2000, the Federal Reserve, led by Alan Greenspan, responded to the dot-com crash by lowering interest rates dramatically. By 2003, interest rates were at 1%, the lowest in 45 years. This made borrowing incredibly cheap. Cheap borrowing meant more people could afford mortgages. More demand for homes meant rising home prices. Rising home prices meant existing homeowners felt wealthier. They borrowed against their home equity and spent more. As the economy grew, everyone was happy. But something else was happening beneath the surface. Banks were running out of qualified borrowers. In a normal housing market, banks lend to people with good credit, stable incomes, and sufficient down payments. These are prime borrowers. They're low risk. But by 2003, most prime borrowers who wanted mortgages already had them. So banks started lending to subprime borrowers. People with poor credit, people with unstable incomes, people who couldn't afford down payments, people who, in any rational system, shouldn't qualify for a mortgage. Why would banks do this? Because they weren't keeping the loans. Here's how it worked. A mortgage company would lend $300,000 to someone who could barely afford the payments. The borrower would sign the mortgage, and the monthly payments would start. But the mortgage company didn't keep that mortgage on its books. Instead, it sold the mortgage to an investment bank like Lehman Brothers. Lehman would buy thousands of these mortgages, bundle them together, and create a mortgage-backed security, or MBS. The security would be sold to investors around the world. Pension funds, insurance companies, foreign governments all bought these mortgage-backed securities because they paid higher returns than government bonds. The mortgage company made money from origination fees. Lehman made money from packaging and selling the securities. And the investors got what they thought were safe, high-return investments backed by American real estate. Everyone in the chain made money, except no one kept the risk. The mortgage company didn't care if the borrower could repay because they sold the loan immediately. Lehman didn't care because they sold the securities to investors. And the investors didn't care because the rating agencies, Moody's and Standard & Poor's, gave these securities but 808 ratings, the highest safety rating possible. But here's the problem. The mortgages backing these securities were garbage. Subprime borrowers with no income verification, adjustable rate mortgages that would reset to unaffordable payments after 2 years, loans with zero down payment, loans to people who lied on their applications. These mortgages were called ninja loans. No income, no job, no assets. And they were being packaged into securities rated as safe as U.S. Treasury bonds. By 2006, subprime mortgages represented 20% of all new mortgages in America. That's $600 billion in subprime loans originated in 2006 alone. And Lehman Brothers was one of the biggest players in this market. But it got worse. Lehman Brothers and other banks took these mortgage-backed securities and created something even more complex: collateralized debt obligations, or CDOs. A CDO took the riskiest tranches, the bottom slices of multiple mortgage-backed securities, and repackaged them into a new security. So the worst mortgages, the ones most likely to default, were pulled together, sliced up again. And somehow the top tranches of these CDOs received 808 ratings. It was financial alchemy, taking garbage and creating gold through complexity. And investors around the world bought them because the ratings said they were safe and the returns were high. Lehman Brothers had over $85 billion in mortgage-backed securities and CDOs on its books by 2007, $85 billion in bets that housing prices would keep rising and subprime borrowers would keep paying. But housing prices couldn't rise forever. And in 2006, they stopped. The warning signs appeared in 2006, but almost no one paid attention. Home prices peaked in mid-2006 and started falling. This had never happened in modern American history. Home prices had always gone up nationally. Local markets might decline, but the national market always rose. Until 2006. By early 2007, subprime borrowers were defaulting at alarming rates. Adjustable rate mortgages were resetting to higher payments that borrowers couldn't afford. Foreclosures were accelerating. And the mortgage-backed securities that Lehman and other banks held were losing value rapidly. In February 2007, HSBC, one of the world's largest banks, announced massive losses on its subprime mortgage portfolio. In April 2007, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. These were warning shots. But Wall Street ignored them. Lehman Brothers ignored them. And Dick Fuld, the CEO, told investors that the subprime crisis was contained, just a small problem in one corner of the market, nothing to worry about. By summer 2007, the crisis was spreading. 2 hedge funds run by Bear Stearns, another investment bank, collapsed because of losses on subprime mortgages. In August 2007, BNP Paribas, a major French bank, froze withdrawals from 3 investment funds because they couldn't value the mortgage securities in the funds. The market for mortgage-backed securities had frozen. No one wanted to buy them. No one knew what they were worth. Credit markets seized up. Banks stopped lending to each other because no one knew which banks were holding toxic mortgage assets. The Federal Reserve had to inject liquidity into the banking system to prevent a complete freeze. Lehman Brothers reported record profits in 2007, $4.2 billion, but internally, executives were panicking. The company had enormous exposure to real estate, mortgages, mortgage-backed securities, CDOs, and direct investments in commercial real estate. If the market kept declining, Lehman would face massive losses. In late 2007, Lehman's chief risk officer, Madeline Antoncic, warned senior executives that the company's real estate exposure was too high and should be reduced. She was ignored. In early 2008, she was removed from risk oversight. Other executives raised concerns. They were told to stay quiet. Dick Fuld believed the crisis was temporary. He believed Lehman could ride it out. He believed housing prices would recover. He was wrong. On March 14, 2008, Bear Stearns was on the verge of collapse. Bear was the 5th largest investment bank in America. And like Lehman, it had massive exposure to mortgage-backed securities. Bear's stock had fallen from $170 per share a year earlier to $30 per share. And overnight, it was about to go to zero. Bear Stearns relied on short-term borrowing to fund its operations. Every day, it borrowed billions in the repo market, using its assets as collateral. On March 13th, Bear's lenders refused to roll over the loans. Bear Stearns ran out of cash. Without emergency funding, Bear would file for bankruptcy the next morning. The Federal Reserve, led by Chairman Ben Bernanke, and the Treasury Department, led by Secretary Hank Paulson, faced a choice: let Bear fail or orchestrate a rescue. They chose rescue. The Fed provided $30 billion in financing. and JP Morgan bought Bear Stearns for $2 per share, later raised to $10. Bear's shareholders were nearly wiped out, but the company didn't collapse completely. The financial system was saved from a potentially catastrophic failure. Dick Fuld at Lehman Brothers watched this rescue and drew a conclusion. If the government saved Bear Stearns, they would save Lehman Brothers if needed. This was the implicit guarantee. Big banks were too big to fail. The government wouldn't let a major investment bank collapse. But Fuld misread the situation. The Bear Stearns rescue had been controversial. Critics said it created moral hazard, encouraging banks to take excessive risks, knowing the government would bail them out. Hank Paulson, the Treasury Secretary, was hearing this criticism loudly, and he was determined that the next major bank failure would not result in a government rescue. After Bear Stearns, Lehman had 6 months to fix its problems. 6 months to raise capital, sell assets, reduce risk, find a merger partner. 6 months to save itself. Lehman Brothers did none of those things effectively. In June 2008, Lehman announced a $2.8 billion loss for the second quarter. The company wrote down $5.6 billion in mortgage-related assets. Lehman's stock fell 10% in a single day. Dick Fuld tried to raise capital. He reached out to sovereign wealth funds, private equity firms, anyone who might invest. But potential investors looked at Lehman's books and saw massive losses hidden beneath accounting tricks. They walked away. Lehman tried to sell assets. The company attempted to sell a stake in its investment management division. Talks with Korea Development Bank about a possible acquisition went nowhere. Nothing worked. By September 2008, Lehman Brothers was out of time. The company had $639 billion in assets, but only $25 billion in equity. That's a leverage ratio of 25 to 1. For every dollar of equity, Lehman had borrowed $25. This kind of leverage is lethal when asset values decline. Lehman's stock, which had traded above $60 per share in early 2008, fell to $14 by early September. Investors were fleeing. Clients were pulling their money. And just like Bear Stearns, Lehman's lenders in the repo market were getting nervous. On September 9th, 2008, Lehman announced a third quarter loss of $3.9 billion. The stock fell 45% in a single day to $7.79 per share. Rating agencies warned they might downgrade Lehman's debt. If that happened, Lehman would face immediate collateral calls it couldn't meet. Bankruptcy would be inevitable. Dick Fuld spent that week trying to find a buyer. Bank of America expressed interest. Barclays, the British bank, also expressed interest. But any buyer would need government assistance. Lehman's toxic assets were too large. A buyer would need the government to absorb the losses, just like JP Morgan had received Fed support to buy Bear Stearns. Fuld assumed the government would help. He was wrong. Friday, September 12th, 2008. Treasury Secretary Hank Paulson called a meeting at the Federal Reserve Bank of New York. Every major Wall Street CEO was summoned. Jamie Dimon from JP Morgan, Lloyd Blankfein from Goldman Sachs, John Mack from Morgan Stanley, Vikram Pandit from Citigroup, John Thain from Merrill Lynch. Paulson's message was clear. Lehman Brothers is failing. We have two potential buyers, Bank of America and Barclays. But the government will not provide taxpayer money to facilitate a deal. If Lehman is saved, Wall Street has to save it. This was a stunning reversal. 6 months earlier, the Fed had provided $30 billion to help JP Morgan buy Bear Stearns. Now Paulson was saying no government money. Wall Street would have to absorb Lehman's losses collectively. Why the change? Politics. Paulson was a Republican Treasury Secretary in the final months of a Republican administration. The Bear Stearns bailout had been politically toxic. He couldn't go to Congress and ask for money to bail out another Wall Street bank. And Paulson believed that letting one major bank fail would send a message that moral hazard had limits. So he drew the line at Lehman. The Wall Street CEOs spent Friday night examining Lehman's books. What they found was worse than expected. Lehman had over $50 billion in toxic commercial real estate assets that were worth far less than Lehman claimed. The losses would be catastrophic. Bank of America looked at the numbers and walked away. They announced on Saturday morning that they would buy Merrill Lynch instead. Merrill, the third largest investment bank, was also in trouble, and Bank of America decided Merrill was a better acquisition target than Lehman. That left Barclays as the only potential buyer. Barclays wanted to buy Lehman, but British regulators refused to approve the deal without a government guarantee. Paulson wouldn't provide one. By Saturday evening, the Barclays deal was dead. Lehman Brothers had no buyer. The government wouldn't help, and the company was out of cash. Bankruptcy was inevitable. On Sunday, September 14th, 2008, Lehman Brothers' board of directors voted to file for Chapter 11 bankruptcy. At 1:45 a.m. on Monday, September 15th, the filing was submitted to the bankruptcy court. 158 years. Survived the Civil War, 2 World Wars, the Great Depression, multiple recessions. Gone. When Lehman Brothers filed for bankruptcy on Monday, September 15th, 2008, it triggered a financial earthquake that nearly destroyed the global economy. Lehman's bankruptcy was the largest in American history. $639 billion in assets, $619 billion in liabilities. The bankruptcy filing itself was 900 pages long, but the size wasn't the only problem. Lehman was deeply interconnected with the entire financial system. The company had over 900,000 derivative contracts with counterparties around the world. When Lehman failed, all of those contracts were suddenly in question. Who owed what to whom? No one knew. Stock markets collapsed. The Dow Jones Industrial Average fell 504 points on Monday, September 15th, the largest single-day point drop since September 11th, 2001. By the end of the week, the Dow had fallen over 1,000 points, but the real damage was in credit markets. Banks stopped lending to each other. The commercial paper market, where corporations borrow for short-term funding, froze completely. Companies couldn't access cash to pay employees or suppliers. The entire financial system was seizing up. AIG, the largest insurance company in America, was on the verge of collapse. AIG had sold credit default swaps, insurance contracts on mortgage-backed securities, and with Lehman's bankruptcy, AIG faced massive losses. On September 16th, one day after Lehman failed, the Federal Reserve provided an $85 billion loan to save AIG. The government had refused to save Lehman but immediately rescued AIG. Money market funds, supposedly the safest place to park cash, started breaking the buck, meaning their shares fell below $1. The Reserve Primary Fund, which held $785 million in Lehman debt, announced it could only pay investors 97 cents on the dollar. Panic spread. Investors pulled over $300 billion from money market funds in a week. On September 18th, 2008, Hank Paulson and Ben Bernanke went to Congress and requested $700 billion to bail out the financial system. Paulson told congressional leaders that without this money, the financial system would collapse within days. ATMs would stop working, businesses would fail, the economy would enter a depression. Congress initially rejected the bailout on September 29th. The stock market fell 777 points in a single day, the largest single-day point drop in history. Congress reconsidered and passed the Troubled Asset Relief Program, TARP, on October 3rd. But even with TARP, the damage was spreading globally. Iceland's entire banking system collapsed. European banks holding Lehman debt faced massive losses. Emerging markets from Brazil to Russia saw capital flight. Global trade fell off a cliff. The Great Recession had begun. In the United States, 8.7 million jobs would be lost. Unemployment would hit 10%. $16 trillion in household wealth would be destroyed. Housing prices would fall 30% nationally, 50% in some markets. It would take until 2014 for employment to recover to pre-crisis levels. And it all started with Lehman Brothers. After Lehman fell, fingers pointed everywhere. Who was responsible? Who should have seen it coming? Who could have stopped it? Dick Fuld testified before Congress in October 2008. He was grilled for hours. Congressman Henry Waxman asked him about his compensation. Fuld had earned over $480 million between 2000 and 2008. He kept that money while Lehman's shareholders lost everything and 25,000 employees lost their jobs. Fuld defended his decisions. He blamed short sellers for attacking Lehman's stock. He blamed the government for not rescuing Lehman when they had rescued Bear Stearns and AIG. He blamed the media for creating panic. But Fuld never admitted that Lehman's business model was rotten, that the company had taken reckless risks chasing profits, that Lehman had hidden losses through accounting manipulation, that the executives had ignored warnings and doubled down on real estate when they should have been reducing exposure. Hank Paulson was also criticized. Why did he save Bear Stearns and AIG but let Lehman fail? Paulson claimed he didn't have legal authority to save Lehman without congressional approval. But critics pointed out that he found authority to save AIG one day later. The truth is more complicated. Paulson wanted to send a message that bailouts weren't automatic. He wanted to impose consequences for reckless risk-taking, and he chose Lehman as the line in the sand. But Paulson misjudged how interconnected Lehman was with the global financial system. He thought Lehman's failure would be contained, that markets had 6 months since Bear Stearns to prepare. He was wrong. Lehman's bankruptcy triggered a cascade that nearly destroyed the entire system. The rating agencies, Moody's and Standard & Poor's, were also responsible. They had given AAA ratings to mortgage-backed securities that were filled with subprime garbage. They were paid by the investment banks to rate the securities, creating a conflict of interest. When the mortgages defaulted, the ratings proved worthless. Regulators had failed. The Securities and Exchange Commission, the Federal Reserve, the Office of the Comptroller of the Currency, all had oversight over parts of the financial system. None of them saw the crisis coming, or if they saw it, they didn't act. And the banks themselves, not just Lehman, but Citigroup, Merrill Lynch, Bear Stearns, Wachovia, Washington Mutual, all took the same reckless bets. They loaded up on subprime mortgages and complex derivatives because the profits were enormous and the risks seemed distant. The entire system was designed to privatize profits and socialize losses. Bank executives made hundreds of millions when times were good. When times were bad, taxpayers paid the bill. Lehman Brothers was the most spectacular failure, but it wasn't alone. The whole system was broken. Here's what came after Lehman. Within 2 weeks of Lehman's bankruptcy, Washington Mutual, the largest savings and loan in America, failed. It was seized by regulators and sold to J.P. Morgan. Wachovia, another major bank, nearly failed and was bought by Wells Fargo. Merrill Lynch, which had been rescued from bankruptcy by its sale to Bank of America, revealed $27 billion in losses in the fourth quarter of 2008. Bank of America needed a second government bailout to complete the merger. Goldman Sachs and Morgan Stanley, the last two independent investment banks, converted to bank holding companies to access Federal Reserve emergency lending. The investment banking model was dead. Congress passed the Dodd-Frank Act in 2010, the most comprehensive financial regulation since the 1930s. The law created new oversight bodies, imposed higher capital requirements on big banks, and tried to prevent future bailouts. But critics said it didn't go far enough, and banks have spent the last 15 years lobbying to weaken it. Not a single major bank executive went to prison. Dick Fuld was never charged with a crime. Neither were the CEOs of Bear Stearns, Merrill Lynch, Citigroup, or AIG. Some firms paid fines, billions in total, but those fines were paid by shareholders, not the executives who made the decisions. And here's the most important point. The banks that survived got bigger. J.P. Morgan bought Bear Stearns and Washington Mutual. Bank of America bought Merrill Lynch. Wells Fargo bought Wachovia. The too big to fail problem that caused the crisis became worse after the crisis. As of 2025, the four largest banks in America, J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup, control over $10 trillion in assets. That's 40% of all bank assets in the United States. They're larger, more complex, and more interconnected than they were in 2008. The system that destroyed Lehman Brothers wasn't dismantled. It was rescued, consolidated, and made bigger. September 15th, 2008 wasn't just the day Lehman Brothers died. It was the day the world learned that the financial system was far more fragile than anyone believed. Lehman Brothers fell because it made reckless bets on real estate using extreme leverage and hid the risks through complex financial engineering. But Lehman wasn't unique. Every major investment bank did the same thing. Lehman just failed first. The government let Lehman fail to send a message about moral hazard. But the failure nearly destroyed the global financial system. Within days, the government abandoned that principle and bailed out AIG, Citigroup, Bank of America, and dozens of other institutions. The lesson of Lehman Brothers should have been that banks can't be allowed to grow so large and interconnected that their failure threatens the entire system. Instead, the lesson Wall Street learned was that if you're big enough and connected enough, the government will save you. Just don't be the first one to fail. Lehman Brothers was sacrificed to make a political point, and then the government spent $700 billion bailing out everyone else. 158 years, $639 billion in assets, 25,000 employees. All gone in a single weekend because executives chased profits, regulators looked the other way, rating agencies lied about risk, and politicians refused to act until it was too late. Lehman Brothers didn't fail because of a market crash or external shock. It failed because of greed, leverage, and systemic corruption. And the conditions that destroyed Lehman still exist today. The banks are bigger. Leverage is returning. Real estate is overvalued. Commercial real estate is facing a crisis right now with $1.5 trillion in loans maturing through 2026. Regulators are easing restrictions that were put in place after 2008. The next crisis is coming, maybe in real estate, maybe in corporate debt, maybe in sovereign debt. But it's coming because the system wasn't fixed. It was papered over with central bank money printing and government guarantees. And when the next crisis hits, will the government bail out the banks again? Or will they let one fail to make a point, just like they did with Lehman? If this showed you what actually happened in 2008 and why it still matters today, subscribe. Because the Lehman Brothers collapse wasn't the end, it was a preview. The system that destroyed Lehman is still operating. The risks are still building, and the next collapse could be even bigger. The warning is written in the wreckage of Lehman Brothers. The question is whether anyone is paying attention.